Okay, guys, so this is the free technical analysis series for trading. Let's call it crypto stocks on a daily time frame and forex to an extent. There is differences and there is different approaches which I take to each thing. But technical analysis basically is the study of price action, charts, and indicators. So indicators are basically analysis done on previous price action and it's pumped into different formulas, and it gives you a confluence, it's called. So a confluence is a reason to believe price is going to move a certain way. The more confluences you have stacked up in your favor, the more likely the trade is to go the way you want it to go. Fundamental analysis is things like news and basically if there's going to be a merger of a company, or someone's just about to pump a load of money into a certain stock or an asset, or for forex, for example, there might be the Fed meeting which affects the price of the US dollar. So every pair currency outside of the US dollar may or may not be impacted. So technicals. Number one is real base gear. We have a crypto called Sandbox over the price of Tether, which is pegged quite closely to the US dollar. Market structure overall. So if there isn't a break above or below a certain area, like a high is taken out with a full body, that would usually indicate that the character of the market has changed. So that was the last high with the wicks. If the wicks get taken out, this is how I classify a breaker structure and the change in market sentiment basically. And then the low here. So from there upwards, the market has been in an uptrend and this low hasn't been broken. This is just noise. So we look at main points over time, see which catch your eye, and that, for example, and then that'll be the next high. So even though the market, it depends how you want to actually chop it up, but there, these are the lows and the highs which have been intact from that technically is a swing. It just depends where you want the main points to be. Depends how you classify it. No break there, lower. So technically that's the next low, even though big sell off there, and that indicates possible coming selling pressure because wicks will usually get filled. It just means the price has traveled there, and then this is the first indication. So a clear swing high here, and that is the first clue that the sentiment has changed. And now this low is starting to get not quite there. So now this low has been taken, that high failed to beat that high, and this low has been taken with some closures. Okay, so now that's the next low. So from there, the sentiment has now changed from an uptrending market to a downtrending market on the daily time frame. So each one of these candles represents a day. Okay, so now rough down, nothing's gone on there, no break. Below, so say that's the next low, depending on how you want to chop it up there, you could say. That would be a high. Again, it just depends how you want to classify it, but we can see that the market is now trending down. and body, yeah, body break. High has not been taken. Oh, we could say that's the highest point. Yeah, so this is an exercise to get up on your own charts and to start to see where the main low and the high points are. Okay, and then that's probably the last. You could say here. Let's just say just for ease. Okay, so what is this telling us? This is telling us what trend the market is in over time. So we'll clear these off. That's handy to know because the trend is your friend. If we're expecting the price to keep coming upwards, the most likely thing to happen will be from a low is to bet that the price is then going back up. Yeah, there's other things going on in between, but on average, when the market sentiment changes, if we get a swing high, we want to bet on the thing, then going lower. So if we get a high here, we want to bet on the thing from there, not beating it and continuing down. It does its little thing, but eventually it starts to move down. Okay, cool. All right, so market structure, a sideways movement, so where price is basically contained within highs and lows, is called a range. So let's try sugar. Let's try and find the range. Basically, there's too much range stuff around it. Up until here, say. It depends how you want to classify it, but lower lows, if you want to classify it as that and take out the wicks. Price has not beaten that. It's tried it again. It's been making lows. Probably not the best thing. It isn't really like a true range. I mean, that's what I classify as a range. But basically, I call this sideways price action, just in general, which is similar to a range. So what usually happens in markets is if we get it on a lower time frame, there'll be an impulsive move, and then price usually goes sideways, impulsive move, price goes sideways, impulsive move, price goes sideways. Most of the time in markets, price is usually just going pretty sideways and pretty shitty, followed by impulsive moves, sideways, move, sideways, move, sideways, up, sideways. Yeah. So we like the market to be trending usually, because if the market's moving sideways, you can't make much movement up or down, so your risk to reward isn't the best. Ranges are usually where orders are sort of stacked in from big institutions, so the movement will be there. If we imagine the psychology, been a big move up, it's pumped, it's broke, all that. So if we look at this here on a lower time frame, oh no. All right, so price pumped, and then what tends to happen is prices moved up from there. People then tend to sell to take profits. Buyers became stronger again and more buying ended up here. Some people still wanted to sell and sold again, but this time price was followed by a movement up. So people who were selling here have just been squeezed and wiped out of their positions, which creates an automatic buy. Push. Okay, again, sideways motion, so chopping in orders, trying a little bit lower, tried it, eventually dipped, and then boom, up. broken that, sideways, up, sideways, up. Okay, so this is market structure. A little bit messy, and your eyes should become accustomed to it, but do yourself a favor and have a look at different time frames, because the market will look similar over different time frames. And basically just get used to drawing highs and lows which break previous wicks with a full body closure, and a decent point what catches your eye where price has moved off from aggressively. Okay, cool. That's someone.